Gotta get started here in a minute.
We'll have to have music at the next one, Monique.
I think we can go ahead and get started so we stay on time here. All right, Chris, you want to kick it off?
Absolutely. And welcome. I will continue. You will probably hear dings on my end as I continue to let people into the room. But very glad that everyone is here and able to join on today for the April 2023 edition of the Southeast Capital Call, co-hosted with our partners at Pinnacle Bank, who is a visionary partner with Launch Tennessee. I'm going to pass to Monique Villa to give a welcome, and then we'll go over the agenda and hop right into it.
Thank you, Chris, and welcome everyone. Just for added context too, and this call predates my time with Launch Tennessee. I joined Launch Tennessee last July as Chief Investment Officer, and Chris had been leading the Southeast Capital calls on a quarterly basis for quite a while, and at some point in time these paused, and so we had the discussion internally to bring these back, but really with the purpose of bringing together not just investors that we see day to day in the Tennessee ecosystem, but more broadly across the Southeast, and also making sure that we are sharing out research and insights that we're finding, but also creating the space for you to connect with one another, build your own networks as well. You'll probably see quite a few recognizable names on the call today, but we also hope to create some space towards the end where you can do some networking through some breakout rooms as well. But we're just really excited about the growth that we're seeing here in Tennessee. We know Tennessee is part of the fabric of a larger geographic region that's experiencing tremendous growth, and we're just eager to be learning together. One thing I also wanted to call out too is this past week, the Wall Street Journal published the latest list of cities in terms of the hottest job markets across the country. And for the first time, Nashville pulled out in the #1 place ahead of Austin. Austin had been leading the country for a couple of years now, and Nashville had been on the rise. So it's a really interesting time for us, but we know that that's not the only city experiencing growth, that there's really dozens of cities across the Southeast and across the country that are seeing that growth. So we're excited to bring you all together, and Chris will take you through the agenda for today.
Awesome. Thank you so much, Monique. As Monique said, I'm Chris Hatch, Senior Associate here with Launch Tennessee, and we are very excited to have each and every single one of you here as a part of today's Southeast Capital Call. Right after I mute and change audio here on my end, you will hear from Evan Przlowski, who's the analyst on our team. He's going to go through our quarterly deal report and talk through some high-level trends that we're seeing here in Tennessee from industry perspective as well as capital invested perspective. He also has a special guest with him who will discuss some other markets around the southeastern region. And then we will have our main event. Brian Bean and Kevin Roddy are going to discuss the venture banking ecosystem post bank run and going into what we hope will be a more stable future for the Southeast and for the industry at large. We'll have some Q&A with Brian and Kevin right after that, so please have your questions ready. What we'll do for that, just for some housekeeping, please just raise your hand in the chat and or via the function there in Zoom, and we will call on you and ask you to unmute to ask your questions. Right after that, we will have breakouts with some questions for kind of ice breaking, and then also to discuss different things that are happening in each of your markets. We will drop those questions in the chat. My suggestion is to copy those, put them in a little note on your computer so that you have those when it's time to start. Otherwise, we'll go ahead and get things going, and I will pass to Evan Przlowski.
Awesome. My name is Evan, so pleasure to be here with you guys. So capital analyst on the team. So here's I guess a little high overview of what has been happening kind of in Tennessee. And so kind of our purpose of this, we kind of want to produce these reports on a quarterly basis. And we've been doing this about close to a year now. And we really try to track the startup funding or VC funding across Tennessee, as well as some of the kind of the venture firms as well that are closing funds and raising funds as well. But I guess for today's intents and purpose, we'll be looking kind of at some, I guess, a quick preview of what's going to be coming in the later weeks. So feel free to, I guess, get connected with us. And if you want to see the finalized report coming out in the later this month. But I guess to start off with, we're really kind of, I guess, despite a lot of like investors' expectations, if you want to go to the next one, and investors' expectations, we're really seeing a lot of outlier, and particularly in this quarter, especially because we had some monstrous deals along the lines with Monogram Health coming in with $375 million. We've had Rain Financial and also Wellvana. And so with those three, it's really kind of really stood out to be for us in the Tennessee perspective. But I think too, in the terms of for the economic, with seeing how the funding's kind of where it's kind of trending, we are seeing a lot of the deal counts start to decline more. So I guess anticipate that may or still be kind of stable in the upcoming quarters and months. Kind of outside of that, I guess for two, kind of looking more of deeper dive what's happening into the stage activity. So we saw a lot of early stage investments, so seed and all the ways to kind of like the Series A/B activity happening, and particularly in the Nashville area. So we saw a lot of the funding from previous quarters that was kind of like spread out to east, the middle Memphis, and the Knoxville and Chattanooga area. We're concentrating more back into the middle regions when it comes to that. Sweet. Then really over this kind of like past year in 2022, like as many of us well know, healthcare is definitely the beast in Tennessee. And we're really kind of seeing that kind of really play out in this quarter and also last year, because last year's funding, we had about 47% in 2022 went to healthcare startups. And so, but however, I think if we kind of start peeling back, one of the areas I think is really exciting for Tennessee that could potentially make a pivot or a really strong, I guess, mark would be kind of the mobility space. So when you start kind of thinking about what Tennessee offers in the mobility area, it's starting like we're getting a lot of these more corporations involved and a lot of these other corporations, whether it's carriers, whether it's from like FedEx to in West Tennessee, we got Geodis kind of like in Middle Tennessee, we got like these automotive companies getting involved now in Middle and East Tennessee. And so it's very interesting play, and I think something exciting about from the Tennessee perspective, and something I guess we'll be trying to follow a closer eye on. So again, we'll be, I guess, publishing a more in-depth report later on this month. So feel free to get connected. I guess we'll pass it off to, do we have Kevin? Would you like to give some quick updates on the North Carolina side?
Hey everyone, yeah, happy to. Can you hear me all right? Good. Cool. All right, great. So I don't have any fancy slides like Evan, but appreciate the chance to talk to everybody a little bit about North Carolina. So hey, I'm Kevin Mosley. I'm one of the general partners of Jurassic Capital, which is an early growth equity fund focused on B2B SaaS. We're based out of Durham, North Carolina, and so far to date, we've got 4 portfolio companies, a $30 million fund. All has been in North Carolina so far, although we do work in the rest of the Southeast. But I will say it's been kind of an exciting last week or two for North Carolina, especially as we just had the CED Venture Connect conference happen last week. Sorry for our Tennessee brethren who couldn't join us. I know you all had your Innovation Week last week, so sorry that those two things overlap. But I will say it was really enjoyable to watch a number of people come in from the rest of the Southeast, but also obviously it's always pretty heavy Raleigh-Durham focused. But we did see a number of folks come in from kind of the outer regions of North Carolina, so whether that's Charlotte, Wilmington, Asheville as well. And so I did pull a couple of stats. I don't have PitchBook access, so I apologize. I'm not going to be able to give you every little bit of detail, but I do have some cool 2022 stats for you. We did find that we end up getting biased a lot by folks like Epic Games. So in terms of when we talk about some of the venture dollars, it tends to be under 50 million or so. What we did find is that in 2022, for all of tech, every category under 50 million, so whether that's under $1 million deals, $1 to $5 million venture deals, 5 to 15, 15 to 30, 30 to 50, every one of those increased by at least 25% over 2021, and then which had also increased over 2020 as well. So we have not seen any slowdown whatsoever. The quantity of deals continues to increase. I think a lot of that is due to just people kind of recognizing what's going on in North Carolina. I think I don't know if we can count ourselves as a number one ahead of Austin in a whole lot of things, but we have found that North Carolina as a state is the number ninth friendliest state in terms of venture capital funding per gross state product. I don't know what that means, but I'll think that's pretty good. And in terms of we are also 8th in the largest job creation rate from tech in general also. So in terms of North Carolina as a whole, it's going well. But I'll say the kind of final piece that I noticed from just general industry trends are that we found last week, at least at the Venture Connect conference, I sat on the selection committee, I noticed a ton of future of work and cybersecurity happening. So that's something that haven't noticed quite as much over the last couple of years in North Carolina, but I was happy to see it. And so, yeah, just in terms of a quick snapshot of what's going on here, happy to pass it along to you all and hope to bring a little bit more data next time.
Awesome. Thank you, Kevin. Now I'd like to pass it to Fasant from Tech Squares. If you'd like to give a quick little update what is happening in the Georgia area.
Sure. Hello, everybody. Glad to be on this phone call. So my colleague Jason Quo is on the phone as well, and Jason was in Nashville last week for the Vive conference. So that was really exciting from a healthcare perspective. In terms of Georgia and Atlanta specifically, I think the city has a very strong corporate presence. So I think outside of New York City, we have maybe the second or third largest number of Fortune 500 companies in the country: Coca-Cola, Delta, Home Depot, UPS, et cetera. Our fund, Tech Square Ventures, actually runs a program with them called Engage to help match startups with those corporates with the goal of building relationships and signing contracts. So to date, 130 contracts have been signed between those Fortune 500 companies and the startups in our program. And so definitely along the lines of what Evan, you were saying before with FedEx, with some of the major healthcare providers in Tennessee, we are trying to do the same thing in Atlanta, just given Atlanta has a large number of Fortune 500 companies. But if you think about sectors specifically, Atlanta has always been a major logistics hub. So you have UPS there, you have major transportation providers there, you have major shippers and carriers there. So you have Georgia Pacific on the shipping side, Home Depot on the trucking side. You have railroads like Norfolk Southern and CSX with major hubs here. So Georgia has always been a transportation hub, especially with Savannah and the port. And so supply chain logistics has always been a major area of focus of ours, and for the city / state. The others, fintech is a big one as well. So many of the large payment providers and payment processors are in Atlanta, as well as SunTrust / Truist being headquartered here, First Data being headquartered here, and several other burgeoning fintech companies. So fintech has always been an area of focus in Atlanta as well. And then healthcare IT, while I don't think anybody could claim that we're anywhere close to what Nashville and Tennessee have, I think healthcare has always been of strong interest, given we have several very, very large providers here: Wellstar, Piedmont, Northside, Emory, as well as Anthem from the insurance and payer side as well. So we have a lot of those people who are interested in innovation and therefore investing in technology. So I'd say those are the major sectors of focus in Atlanta and in our state in terms of overall activity. I think it's still very healthy. I think it's down versus maybe 2020, 2021 and maybe part of 2022. But I think one of the trends we have here, which I think Nashville and Tennessee have in spades as well, is people relocating from other parts of the country that may be high cost, high density, and looking to move to places where there's a growing amount of startup talent and low cost of living and a great quality of life. So we still see that happening in spades in Atlanta.
Awesome. Thank you so much, Kevin and Vasant, for that insight. As you all can see, there's a lot happening in the Southeast from a entrepreneurship and venture perspective. Also, could we please give a big virtual round of applause to Evan Przlowski, who led this segment? Awesome. Thank you. Thank you. So moving on to our main event, which we are all super excited for, our visionary partner, Pinnacle Financial Partners, is our co-host for this quarter's event. As a reminder, the Southeast Capital Call is a quarterly event for investors exclusively. And so we are super excited to have them to discuss their view and understanding and provide some critical insight into what is happening in the venture banking space and how we can all move forward. And so I will pass to Brian and Kevin to introduce themselves. Please give them a great virtual round of applause as well.
Great, thank you. Really excited to be here and excited to see a few friends on the phone. So we've been looking forward to this. I think we want this to be, we're going to provide some information, and then we're hoping to spur some conversation and questions. So our goal is to keep our comments, down the fairway, but then we want to veer off as you guys want to as well. So the idea here was to talk about what has happened over the past 3 weeks in the world of banking, and then how does that affect the world as it moves forward, particularly in venture capital. So let me just start briefly. My name is Brian Bean. I lead our corporate banking team at Pinnacle. Been at Pinnacle for about 8 years. We work quite a bit with financial sponsors. And if you're not familiar with Pinnacle, we're about the 35th largest bank in the country, about 42 billion in assets. So we are a mid-sized regional bank that has been much maligned in the media over the past few days. So, we partly feel like we need to vindicate ourselves and stick up for ourselves. But, we feel really great about the role we play in the American economy, and, that mid-sized regional banks are really important. So we may get into some of that as we talk. I will get us started, and then we'll hand over to my colleague, Kevin, for him to make. Well, Kevin, why don't you go ahead and introduce yourself now?
Sure. Thanks, Brian. My name's Kevin Roddy. I've been with Pinnacle for 14 years now. Brian gave you a little overview of the firm, and it's been a pleasure and privilege to be a part of the growth of Pinnacle over the last 14 years. I work with a lot of small to middle market commercial businesses, as well as sponsored backed companies, which would fall into that category as well. So it's a pleasure to be here.
And I apologize that I look like I'm in the witness protection program. I've got like a shadow on me. So sorry that I guess my camera is not getting much light. So hopefully that's not a distraction. You're not looking at me anyways. We'll look at the slides. All right. So getting right into it, I thought we would start with, how did we get here? What brought us to this? And as I reflected on this, you get a bit of PTSD as we all try to forget that 3 years ago, COVID hit and the world was turned upside down and we closed our economy. But I think it's important to think back, because I would point your attention to that period of time as when this saga began. I'm going to make a lot of comments today. I don't mean any of it to be pointing a finger or placing blame. I intend to talk about facts of what happened and what took place and what the effect of decisions were. So, I don't want comments to be misinterpreted that I think someone did something wrong or inappropriate or whatever. So there's no political comments, and there's no comments against any of our competitors, because we will also talk about some banks in our comments today. So on the page here is a bit of a reminder when COVID hit, and the economy closed down to protect health first and foremost. Our the leadership in America and across the world said, look, we got to protect the health of our people first. And so social distancing and 2 weeks to slow the spread and, all the things that we remember, came into play. And there was a realization that fiscal and monetary response would be needed to make up for the idea that you can't just close an economy down and expect things to go well. And so I've got on the left side fiscal policy and stimulus. So think Congress mostly, Congress in conjunction with the Trump administration on the first couple of items. And on the, as you go down the list, it crossed over into the Biden administration. So you had two administrations that were involved and Congress involved in writing these acts. All told, $5 trillion of spending was put in place at that time. And these bills covered a wide range of things that we would spend the next 4 hours talking about. We all remember it, no reason to go through it. But many of the items in these bills were aimed at keeping the economy afloat, putting money into the pocket of families. There was COVID response, there was COVID testing, a number of things that these bills were used to fund. But the sheer magnitude of it is really what I want to focus on. $5 trillion is unprecedented. 1.9 trillion was the last one. 2.3 trillion was the first one. Those were by far and away the largest spending bills that had ever been passed in American history, and there were two of them done a year apart. So I really just want to point your attention. These are obvious statements. We all remember it, but I think to talk about how we got here, you can't not talk about the massive amounts of spending that were done in response to COVID. On the right side is monetary policy. Fed funds was cut to zero in March of 20. You may recall that the Fed had been steadily increasing rates since about 2016. Now, at the time, rates were not high. We were in the mid twos on Fed funds. But when COVID hit, rates were reduced to zero. Quantitative easing was put onto hyperdrive, where the Fed takes certain actions in the open market to buy bonds onto its balance sheet that injects liquidity into the economy. Much of the Fed's focus was on maintaining liquidity. The Paycheck Protection Program, Kevin and I certainly have a certain amount of fondness that we remember in that, because banks literally, not just us, but many banks work 24 hours a day. We had 3 shifts. There was a 8 to 4 shift, there was a 4 to midnight shift, and there was a midnight to 8 a.m. shift. And literally banks did that and worked 24 hours a day to get Paycheck Protection Program loans done for their clients. It was a wild time. And then the last one, this is a number of programs, many of which you may not have heard of. Many of them flew under the radar, but they were all about keeping liquidity and dollars in the hands of businesses and ensuring that our system functioned properly. Anything from money market liquidity to commercial paper, primary and secondary corporate credit facilities, a term, the TALF is a term asset lending facility. These were really aimed at keeping banks operating, keeping corporations liquid. So wanted to review those, probably an era we've tried to forget. So we can go to the next slide. On the next slide, what I want to show is the inflation rate as compared to the Federal Reserve interest rate. And I am going to throw a little bit of shade at our Fed. I'm trying not to be too, pointing fingers, but I think the point I'd like to make here is inflation began to show up in June of 2020. So the first bar that you see, the blue bar, is inflation rate. In June of 20, kind of on the left side of that red circle, we started to see inflation. And if you'll remember, there was a lot of talk at the time about inflation is transitory. There are just effects of all the spending. It's going to work its way through. And that had some validity. We'd shut down our economy. All supply chains had closed. All workers had gone home. And so as there was a rush to reopen, workers were up for grab. Supplies were up for grab. And so there was suddenly the ability to bid prices up because there were a whole lot of dollars. Remember the $5 trillion of direct spending, plus all the liquidity programs that I just walked you through. There were a whole lot of dollars chasing not enough workers because many people were hesitant to come back to work, and not enough goods because the supply chain was not fully open yet. And so you see from June of 20 through really June of 22, no action from the Fed. And as you see the blue bars begin to grow, at first inflation was, low, but in the early days, you would say it was just returning to where it was before. If you look at blue bars pre-COVID, hey, it's just getting back to where we started. But then suddenly in April, June of 21, you see inflation really start to kick up to 5%. Then it surpasses 6% in early 22, then gets past 7% and all the way up to 8% before we really see any action from the Fed. And so I guess the main point here is there is an assessment, I think, now that perhaps we waited too long. There's plenty of commentary that probably should have started a little sooner with some rate increases. I'm sure at the time there was concern and caution about not wanting to act too quick to dampen the recovery. But I think now in hindsight, we can see that really led to massive amounts of inflation. And really, you don't see the Fed rate get back to where it needed to be and to where it started pre-pandemic until July of 22. And so that's a full 2 years and a few months of inflation that got loaded into the system without any response. Okay, next slide. So we're going to talk about Silicon Valley Bank. All of the stimulus dollars, all of the liquidity, all of the money that flooded into the system went into banks. All banks, not just Silicon Valley, but all banks experienced, and I'll talk about this in just a minute, all banks experienced, I'll tell you what, actually, let me do them out of order, or the order I should have done them in. Go to the next slide, if you don't mind, Chris. Here we go. All banks experienced an increase in deposits. So this is SVB is the blue line, and the orange line is all other banks. So there was a growth in bank deposits. You can see the orange line, all banks experienced an influx of deposits. Pinnacle did, all of our peers did. What SVB experienced was well above the average, as you can see in the comparison here. So now, Chris, maybe jump back to that previous slide. SVB grew from about 50 billion to 200 billion. So almost 4 times the growth, 220% growth. That is just an unprecedented amount of growth. And let's call it what it is. Silicon Valley Bank was an excellent bank for venture capital, and they were really active. They did a great job with connectivity, with relationship, the services that they provided. I want to be sure to point out that they are in many ways a victim of how good they were. Their success in the space was known by many in the industry, that they had expertise, they had people that did a great job covering the space. And so as firms had mass amounts of liquidity either at firm and fund level or down at portfolio company level, SVB was a huge beneficiary of that. And that's not a bad thing. They were happy about it at the time. That's market share growth for their bank. That's funding. And so I'd say you can go to the next slide, Chris. Covered that. So now, what happened at Silicon Valley Bank is they didn't have enough loan demand to cover the deposits that came in. Deposits come in. Banks are nothing more than we take deposits and we bring in that money. We push the money out the door in loans or investments. They did not have enough loan demand, so they chose to invest those dollars. And as you can see, we put some of this together for comparison for our clients. So not trying to be a commercial on Pinnacle Bank, but this is data we had available. Their total securities portfolio, so their investment book, as compared to their total assets. So they had 55% of their bank was in securities. The industry average is 21%. As a comparison, we're at 16%. And so you can see how much of their bank flowed into investments, and you can understand the rationale. They were flush with liquidity and they needed to do something with it. You can't let it sit idle. There is a cost to those deposits, and so they needed to earn a return. The challenge that they had was, and probably the mistake they made, is that they chose bonds that were long dated and had interest rate sensitivity. They were chasing yield, most likely trying to produce more return on that book. And so the bottom chart shows that what happened was as rates went up, of course, everyone knows the value of those bonds went down. The bottom chart shows that it's tangible common equity. They had 100% loss in their adjustment. If you adjust out the losses in the bond book, it completely wipes out the tangible common equity of the bank. And so that's what happened, technically speaking. They were caught with their success drove them to invest in a long-term securities book. When rates rose, that book went underwater, and that loss was more than the common equity of the bank. And so they were insolvent. When that became apparent, depositors began to pull their money from the bank, and that's where we ended up where we were on Friday, March the 13th. We can jump to the next slide. Those depositors, as they showed up, were concerned because they had a very large portion of their deposits were uninsured. And so this shows SBNY is Signature Bank, another bank that, of course, did not make it, and Silicon Valley Bank. Those are the two highest. The bar chart almost doesn't do it justice, but they both are about 90%. The industry average is about 45%. We're 45%. JP Morgan's 45%. B of A is 45%. 45 is a industry average, very normal amount of how much of your deposits are above FDIC coverage. They were at 90. I've seen some numbers that were quoted even higher than that, but I think 90 is a safe number. And so they had a lot of their depositors that were uneasy, that were concerned, and chose to pull their money out. And so I think, the bank was, unfortunately, again, due to their success, they were built for a run because they had such a high deposit base that was uninsured. Jump to the next slide. And so I'll hand to Kevin. I think now, what we want to touch on is how does that affect you? How do you think about banks going forward? How do you interact with banks, choose banks? How do you protect your dollars if you have deposits sitting around? What are strategies that are real life, real world actions that you can take?
Thanks, Brian. In some ways, I think the episode or the events of the last few weeks has turned things on its head a little bit with regards to banks as well as their clients. Banks and investment firms have a plethora of regulations, too many to count, quite frankly, that allow us to know our clients, KYC requirements, require banks and investment firms to understand the clients that we are dealing with, the source of the cash that are in our banks or that we're managing, what is the intent and purpose for that cash, how many transactions can we are expected in any given month. So that's KYC, but now the moniker becomes KYB, know your bank, because I think what's readily apparent to many bank clients because of the events of the last few weeks is the fact that your deposits are essentially unsecured loans that you are making to the bank that you are working with. So when you put a deposit into a bank, the expectation in the implied agreement is that you're going to get that money back at par and maybe a little bit more if you include interest. But what's happened is, and when you put that deposit in the bank, and this is overly simplistic, but this is, Brian mentioned the very simple banking model earlier, which it truly is. When banks take those deposits in, we lend those deposits out in the form of loans. So it's incumbent upon us to make sure we get that money back and make those loans in the most risk-free way possible. And there's regulators to make sure we do that. But now, unlike 2008, when assets or loans were really the problem and many banks went under because of SVB and some of the, as I said, what's happened in the press, and the events that have transpired the last few weeks, people are asking questions about their deposits. So, are they safe? Can I get them back when and if I need them? So the question becomes, how do you assess the strength of your bank? Chris, go to the next slide, please. And I know there are some very sophisticated people, financially sophisticated people on this call. And so you could do that a couple of different ways, one of which is to look at the annual report at any given bank and look at a variety of different metrics that bank will put out to assess their strength, both from an asset or a loan standpoint, what kind of loans are they making, as well as a liability or deposit standpoint. What is the liquidity of that bank? Can I get that money back out? What is the diversification of deposits? And quite frankly, there's a whole host of metrics that until about 2 weeks ago, I, for one, never really thought about. What is the percentage of uninsured deposits? What is our unrealized losses on held to maturity securities? Again, it's a new world out there, but those are numbers and metrics that people are asking about today. And you can find those with most banks, and using Pinnacle as a proxy. And as Brian mentioned earlier, we're not intending to make this a Pinnacle commercial. And I would submit that while we look good, there's probably a whole host of regional banks in the Southeast and across the country that may be look even better than us in terms of the liquidity and the metrics that one would use to assess the strength of that bank. And so that's what I would, if you're so inclined, you can find that financial information fairly easily if the bank is publicly traded. But I think where we're going, and next slide, please, Chris, is, I think where we're going is maybe, and this is overly simplistic, and if any of you know me, that's sort of the way I operate, but I think it's back to banking 101, which is banking is a relationship business. With the partners or the clients that we have, we're looking to have a partnership with them, just like they want a partnership with us. And that is both on the side of treasury manager deposits. In other words, what services do we provide that allows for the efficient transmission or inflow and outflow of their funds from clients and or vendors. And then on the lending side, when we make a loan to any client, we are assessing the quantitative risk. What is their capacity to pay us back? But likewise, there's the qualitative risk. Do we know our client? Do we know, like him, and trust them? And I think because of this, the events of the last few weeks, that relationship where both the client and the bank are looking for that mutually beneficial partnership, I think that's becoming reinforced, especially for early stage, small to middle market commercial clients that, quite frankly, are much better served by community and regional banks. They just are. I don't see us going back or going to an era where we have four super too big to fail banks that are regulated by the government. I think, and the reason I say that is I think anecdotally, the community regional banks are just too important for American business to go away. And that's confirmed by the facts. I was looking for some information in preparation for this call, and I read a recent study by the Fed in Kansas City that showed that almost 60% of loans to American businesses are made by banks with assets of $100 million or less. As Brian said earlier, we're a $43 billion bank. So you include regionals, we are arguably the cornerstone of American commerce and business. So I think, what the government did in safeguarding the banks and putting steps in place to make sure banks are secure, and more importantly, make sure your money is secure. I have to think that will continue, even in an environment like we're in right now, where there are some continued questions about regional banks in particular, and some of the safeguards that are in place. So, as I said there, I think what we're fearing, like 2008, is that the regulatory environment will get worse, meaning there will be a lot more regulations that banks have to jump through. It will become more expensive for banks. And the result of that means that banks will have to keep more reserves and maybe tighten their credit standards. It may get tougher to get a loan from your bank just because the regulatory environment requires banks to keep more reserves on their balance sheet as a safeguard for worst case scenarios. I guess if there is a flip side or silver lining to that, if banks do make fewer loans, or if credit starts getting a little tighter, that is by definition deflationary, and so rates may come down as the economy slows down the latter part of this year, which many people are expecting. But I think bottom line is, what we're trying to do, and it's overly simplistic and a little cliche, but we, community regional banks really are there to serve sponsor-backed companies, small to middle market commercial businesses in a mutually beneficial way, so that we can grow our businesses together. And that's one of the, that is the case back in 2008, although it went when banking went through a similar disruption, and I think that's the case today and also going forward. So next slide, Chris. So how do you protect yourself? Understanding the need for partnership with your bank, how do you take the extra step to make sure that your deposits are secure and that you're stemming the systemic risk that, or minimizing the systemic risk that may be there? And that's understandable to have that concern. And there are some strategies that will allow you to maintain that relationship with your bank, but also achieve a rate or a level of FDIC insurance safeguards that's far in excess of the $250,000 maximum. That's the limit today. There are some structuring, FDIC structuring techniques you can use. FDIC insures up to $250,000 per owner. So if you are a individual client with a spouse and kids, there are ways that you can achieve FDIC insurance just through account ownership strategies well and above the $250,000. One of the tools that we've been using extensively the last week or so is this ICS product, Insured Cash Sweep. That is a product that most banks have, I believe, at least in this market they do, and that allows for FDIC insurance all the way up to $150 million per client. And it's a pretty efficient way to achieve that insurance. There's some talk on the media, especially, that says that you need to spread your money out across various banks, especially if you have large deposits in any given bank. Don't necessarily disagree with that strategy outside of the extreme inefficiencies of doing that, having multiple bank relationships that sort of go against what I talked about earlier, which is having that primary bank relationship. You want that relationship and partnership, but how do you ensure large deposits yet maintain that primary bank relationship? ICS is the answer to that. And so the way that it happens simply is if you had $1 million, what ICS does is allocates $250,000 of that $1 million balance across 4 different banks, allowing for FDIC insurance of the full $1 million. We get the money back. Pinnacle, if Pinnacle is the holding bank, we get that $1 million back through a reciprocal agreement. But bottom line is that the money is completely liquid, and you have full FDIC insurance and interest if it's an interest-bearing account in a way that you wouldn't have otherwise outside of the ICS product. Repos, again, that's another strategy that's coming into favor in the interest rate environment we're in, where basically money swept out overnight into treasuries and then swept back the next day. It's a great way to minimize your interest expense if you have a loan and maximize interest, the interest you can get paid if you're in an interest-bearing account. And then treasuries. Again, you can ladder treasuries through your bank or investment advisor. So those are 4 strategies, common strategies that we've seen used recently. I'm sure there are others, but I think that gives you a flavor of what's possible. And if you have questions, it's always good to direct it to your bank partner, whether it be here at Pinnacle or elsewhere. And I think that, Brian, did I leave anything out?
I think that's all we have. We'd love to hear questions. Yeah. If there's further conversation you'd like to hear from us on, the fun we've had over the last few weeks, we're happy to answer any questions or what we're hearing and seeing. So.
Awesome. And just a reminder on housekeeping for questions. Forgive me, we actually don't have the raise hand function in this form of Zoom. So if you have a question that you want to speak and just come off mute to say, just type question in the Q&A, we'll call on you, or you can type your entire question into the Q&A section, and one of us will read it off for you, and Brian and Kevin will answer it for the group. Thank you so much.
I thought I just saw a raised hand. Was that
You can also use the emojis that are built
Maybe
in
that
there,
was
or reactions that are built in
maybe
here.
that was it. I was hoping someone would throw us a curveball today, something really hard.
Bar's pretty low there.
Okay, we've got one in the chat, and then I'll go to Jason to unmute. So from the chat, Rachel Wilson with Collab Capital wants to know, what type of debt facilities are you seeing being used in the startup space?
Yeah, good question. I think that yeah, I've had this discussion with a few others. So I believe there will be a pullback in debt facilities for early stage pre-EBITDA businesses. Again, giving a nod to Silicon Valley Bank and maybe a couple of others who had the capability and willingness to lend to companies that were earlier stage and that perhaps were prior to positive EBITDA. They had built some business models around that. We are seeing that dry up. And so I know that's not good news, but you're asking the question, so I want to give a straight answer. I would call it a specialty product in the industry. Most banks did not offer that type of financing. As Kevin walked through, banks are typically looking to be right 99.8% of the time. And so meaning we can only have about 0.2% of our loans not work out the way we expected. And so that just drives banks to often underwrite to some pretty tight standards. And again, because of regulatory implications, that is reinforced there. And so you see most of the market not participate in debt facilities that are like what I'm describing. So I'm going to touch on those first. So I think that will change. I think there'll be less of that available. So that's a bad news for earlier stage companies. I think that will probably result in different alternatives. What's great about the American economy and American ingenuity and creativity is when there is an opportunity in the market where a competitor or someone exits or something is, moves, often the void is filled. And so my expectation would be that debt facilities will probably be filled in perhaps by non-banks more so. Those types of firms already exist, already have active lending. I think that banks, you'll see a pullback. And so perhaps non-bank lending would be the way that would get filled. I would say that's for portfolio companies. For venture capital and private equity, what hasn't changed is, this isn't an arena Pinnacle plays heavily in, is subscription line financing at the fund level. That's still very much alive and well and active. So we have not seen a change in that appetite level. To Kevin's comments, I guess the last thing I would say, for EBITDA positive companies that have hit some scale that would typically would underwrite for typical traditional credit facilities, senior credit facilities, I do think those standards are tightening. There's two things that are driving that. One is the regulatory expectation. If regulators are going to pass along that banks have to hold a higher capital level and hold more liquidity, then the first thing that banks are likely to dial back on are loans that are perceived to be higher risk, higher leverage loans. And so they're going to first maybe look at those to scale down a little bit so that they can preserve their capital and build the balance sheet to meet the regulatory burden that's there. There's also a wide expectation that perhaps a recession's on the way. And so like any rational business person would do, you're going to be careful about looking at projections for companies and how they can meet those projections for underwriting. So I think that we've seen that happen as well. So I'm happy to talk more about the lending market, but I'll stop there. I think you got a feel for it. Not a good news answer, so I'm sorry, but I want to give you an honest answer.
Honesty is the best policy. So moving on to Oscar Lee, who has a question. Can you talk more about ICS? Have you seen more startups using this? What risks are associated with this strategy?
Kevin,
So we have seen a number of startups, especially those that raised significant amounts of money, use ICS as a way, as I said, to achieve FDIC insurance for the full amount, at least up to $150 million. And unfortunately, I've yet to have a client that has bumped up against that $150 million cap. But basically, what is the risk? Minimal. As I said, it's a fully liquid product where you can put that ICS wrapper, if you will, around an operating account or a money market account, where typically most companies who raise significant amounts of money, they would put it in that money market account, ask the bank for a meaningful rate of interest, which side note, where we are in the banking cycle right now, our bank and really every bank are starving for deposits because of loan demand that is still there, but also because of our need to stay as liquid as possible. So if you have large deposits, now's a good time to approach your banker for a quote preferred rate of interest on that deposits. But back to ICS, again, it is allocated, that back to the $1 million example, that $1 million allocated over 4 banks in $250,000 increments. If you were a Pinnacle client, you would see the balance of that on a daily basis on your online banking. And there's a separate portal through ICS or IntraFi. That's the company that basically runs and owns this ICS network. You can log into that portal and see the underlying banks where your money is allocated. So if you're talking about the risk, maybe you're implying what happens if one of those banks fails. There are 3,000 banks in that ICS network. And if one bank fails, then another bank comes in and takes its place. That money is allocated, that 250 is given to a successor bank that is in good standing and in business. So in that scenario, you really wouldn't see, there'd be no loss. If our bank were to fail, on the next statement you receive, you see XYZ Bank replaced by ABC Bank. So it's really ingenious may be a strong word, but I guess in an environment like we're in right now, it's really a effective tool for those that have large balances that want that full FDIC insurance possible.
Awesome. Robert Faber has a question. Brian, has there been a recent situation where depositors weren't covered and or made whole by the federal government, even above the $250K FDIC insurance threshold?
Hey, Robert, good to hear from you, man. Hope things are good in Tampa. No is the answer. I think you're going to think I planted that question. We've had a lot of talk about FDIC coverage, and the fact is that it's smart business to protect your risks. It's smart business to put yourself in a position where you're not taking a chance. We hear often from people, that if they're sitting on a certain amount of money, they have a fiduciary responsibility because it's not necessarily their money. They may be managing that money on behalf of someone else. And so they feel the need to do everything within their power to ensure it. But Robert, to answer your question, no. I mean, the government stepped in and insured all the deposits that were at risk. During the financial crisis back in 07, 08, 09, when there were a lot of bank failures, those banks closed on a Friday and opened up under, a B of A flag or, a city or a whoever, and their deposits were covered. And so the FDIC is a public confidence tool. I think, there's an understanding that companies and wealthy individuals are going to hold more than 250 in an account just because of necessity and convenience. And so it is a curious question. You don't want there to be the moral hazard from people from banks and clients to say, oh, I know the government's got me anyways, no worries, right? But you also don't want there to be a concern that I can't even put my money in a bank because most of the public is not in a position where they feel confident to analyze the financial position of a bank. Not to mention, it can change quickly. Silicon Valley Bank was not in the precarious position that they found themselves in for very long. It was a fast change that, the risk came on for them quickly. And so if you weren't really watching their quarterly filings, you may not have noticed that their balance sheet changed dramatically and that they brought on a significant amount of interest rate risk in that bond portfolio. So that's a long answer to say, no, it hasn't really had to kick in. The government has always, I guess, saved the day. It's not a reason, though, not to probably do, what you can to structure your accounts like Kevin's been talking about.
Awesome. I want to make sure there's no one who is hoping to unmute to ask their question. I think we're all pretty polite here. So if you would like, feel free to go ahead and unmute, ask your question, and just be conscious. In case you hear someone else talking, holding space for people to find the button. Okay, I'm not seeing any other questions in the Q&A or in the chat either. So Kevin or Brian, any final words you'd like to leave with the group?
Yeah, I guess just thank you. Appreciate y'all's attention to this. We're not it's not often that banks are a interesting party conversation, but the last few weeks working at a bank, I've had friends and family members that want to talk about banking suddenly, which has been a strange thing because that's never the case.
I don't know how to handle it, Brian.
I know.
Maybe we can offline.
Really,
I've got to know. It's freaking me out, quite frankly.
Yeah, it'll pass quickly. We're not going to be cool for long. So, I would say, obviously, I think maybe our contact info will be passed around. If you have other questions or comments, we'd love to hear from you. I would leave with, I feel like we've had a lot of bad news. So let me leave with some good news. And some encouragement, I guess, would be to say, the venture ecosystem is vitally important. The American economy and the capitalism of, I have an idea, I need capital to grow that idea and scale it and produce return to create jobs, to change my community, all the reasons that many of you do what you do is we really are impressed, and we what's the word I'm looking for? It's an important part. We work at a bank. We don't take the kind of risks you guys take, maybe, but it's an important part of the economy, and it's important that it's healthy. It's important that it functions properly. Banks do play a role in that. We play a role that needs to be thought about, and that needs to be handled in a careful way to balance risk, because we don't want to sink the American banking system by making bad decisions. But that's not been the case. And so what we haven't liked to see lately has been, venture has been sort of put in the paper, and banks have been put in the paper with a negative connotation. And so I just want to kind of tip the hat as we leave out to say, what you guys do, it's super important. The jobs you create and the food you put on tables, we salute that. And, I think there's a healthy way forward that this ecosystem is going to continue to thrive. So I'll end with that.
And I just want to thank y'all for your support of Launch Tennessee, and thank Launch Tennessee for the opportunity to be here, but also opportunity to be their partner. As Chris mentioned earlier, Pinnacle has made a pretty significant investment in Launch Tennessee to support their efforts to continue to support entrepreneurs across the state. And it's not just good business for us, but it's the right thing to do. And so we're thrilled about the partnership. We look forward to the opportunities and the privilege to work with them, and perhaps some of you in the future. And thanks for your time today.
Awesome. Once again, thank you all for your time and insight and your support of our work. So really quick, we're going to move into our breakout sessions, as mentioned at the top of the call. So what's going to happen here, I'm sure you guys are all familiar with how breakouts in Zoom work at this point, 3 years post the pandemic, but just in case, so you're going to go into virtual rooms. You'll be sent automatically into the rooms. I'm going to drop the questions here in the chat here in a moment before everyone goes. And we just want you all to have free and open conversation with the folks in your room. Feel free to network. If you guys go off topic, that's all good. It's a kind of carrying on we want to see. So enjoy. But really quick, before I let you guys go, in case some people have to leave from the breakout rooms, I do want to make sure that you know that we have a few events coming up that we would love for you to know about. LaunchTN has our next open house in Nashville, June 21st. We'd love to see everyone there. Our next Southeast Capital call scheduled for July 26th. 3686, the dates have been announced. Please join us September 19th through the 21st here in Nashville once again. And then the Southeast Capital call, my edit didn't make it into the presented slides, but October 25th, we'd love to see you all there. So we're going to go ahead into the breakout rooms, and here are the questions, rather. Everyone a moment, and then.
Right, pressure.
Great job, man.